Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, April 19th, 5 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in an uptrend, still recommending staying away from regional banks and commercial real estate. Check over here at the trend gauge. Leaders flagged as neutral. There are a couple that are having lockout type rallies, but for the most part, we're seeing a lot of chop above, at and above the 21-day moving average. So plenty of stocks to get on the list, but it's very few that are seeing strong breaks higher. Maybe that'll change as we progress through earnings season, which actually has been companies have been beating their targets on sales and earnings. We're approaching about 15% of the S&P reporting, and so far so good. Uh, so anyway, neutral on leaders. Short term, IWM undercut reclaimed the 21-day moving average today. That's its third close above the 21. So we get to take off all of the let's call it subtitles, where we were saying all four of the five indexes were above the 21 and small caps were below. Now we've just got the green arrow with no disclaimer. Medium term, the big cap index is looking healthy above their 50-day moving average. Mid and small, not so much. Still a hangover from the bank liquidity crisis, mini crisis, I should say. Long term, four of the five indexes above their 200-day moving average. Small caps trying to recover, but it's been a slow slog. However, KRE up almost 4% on the day. So as more of these regional banks report earnings, perhaps the market can see that it was more overblown than it needed to be. We'll take a look at some charts that reflect that today when we get to the tail of the tape and the focus list. So what happened today? Gap down, ugly gap down at the open. It was blamed on um, really bad data coming out of the UK relative to inflation. And I mean, everything was down. Gold down, bonds down, stocks down, dollar up slightly. But that gap down, we put in the bottom within the first 30 minutes, right near the open, recovered most of the gap down and closed mixed. So this is a win for the bulls as they continue to buy the dip. Here are the numbers on the day. The Revere Growth 7 Composite ETF down 0.36%. S&P 500 recovered from a 0.45% gap down to close basically flat. NASDAQ 100 gap down 0.75, closed down just barely, negative 0.05%. Dow gap down 3/10, closed down 2/10. Mid caps positive by 2/10. Russell 2000 small caps gap down 6/10, closed positive by 2/10, and a lot of that ground that was made up during the day was in regional banks. Global diversified 60/40 stock and bond down 0.19%. Both stocks and bonds red. In-house GROTECTION down 0.19%, in line with the 60/40. Today is weekly chart Wednesday. That means we're going to blast through the 21 over 21 on a weekly look, and a lot of insight to be gained by taking a step backwards. So let's get right into it. And since my favorite Excel chart popped up, we'll get right into why we do what we do here at Revere, and that is active management in a goal of preventing big drawdowns as people enter their twilight years, their retirement years, have saved their nest egg for decades. We don't want to see that dissipated through a negative sequence of return scenario for us. So our first job is every trade we make, every ETF and stock we buy, we think about how much can we lose to the downside in this? And we take a look at the indexes, we take a look at leading charts. That's what dictates how much exposure we have to the market. We dodged this COVID drawdown. 5 weeks, we were down less than double digits. Last year, market down 27.5%, high to low. We were down less than half of that. We think we're doing our job when we do that. When the market gets back to healthy, the gains will take care of themselves. And if you're interested in this approach, reach out to me, Don at RevereAsset.com, or my partner Dan Stewart, Dan at RevereAsset.com, or phone 855 Real Wealth. That's 855-732-5932. So here's the S&P 500 index. You can see the takeaway is that it continues to trudge higher along. Is trudge a word? It continues to trend higher. Every time it touches the 8 EMA, it bounces off of it and goes higher. Let's look at this 5-minute chart. You can see the gap down here, put in the close immediately, slow trend higher. 2 p.m. the beige book came out. We tried to break out above that. That failed. Based till late in the day, and then a V into the close, sell off, buyback, 41.50. We've been watching that area. We undercut it at the open. We reclaimed it. We tested it at the close and bounced there. That's a good sign for bulls. All in all, today, when you gap down nearly 0.5% and recover to flat, that's a win for the bulls. And you can see the daily chart. It keeps the uptrend along the 8 EMA intact. It also keeps this barely a breakout above 41.20-ish intact too. We've got three critical layers of resistance overhead though. 41.55, which is where we've closed the last 2 days, is a big fib level. 41.90 is 20% off of the low from last October, and 41.99 is a 23.6 fib off of the COVID rally. So a lot of key levels here. You can see that 41.95 is where we failed back in February, too close to that 41.99 fib. And that's where this move higher continues to get knocked back. The next level down, 41.55. So those are the key levels for bulls to overcome. NASDAQ 100, as I said, uglier gap down today, broke below the 8 EMA, closed back above it. You can see the slow recovery. Again, this is a win for the bulls. Failed breakout yesterday, didn't make a higher high today either, but we're hanging in there above the 21. We've been more volatile versus the 8 EMA than the S&P 500 is, but and lagging slightly on relative strength over the last 2 weeks. But after a strong relative strength move before that, it's fairly typical to rest for a while. So this level that we need to get above the lowest, the most recent levels is 322-ish area, 334, the high back here from last August. Dow Jones Industrial Average is tightening. Look at this. You draw this downtrend line here, an inside day here, 3 days inside last Friday's candle, really tight. Relative strength lagging a bit over the last week. See if we can blast above this 34,000 level. Not getting any help from its highest priced stock, United Healthcare, UNH, down 3.6% today. But Goldman Sachs continues to recover off of its earnings gap down, so a mixed bag there. Mid caps continues their tight trading, 7 days now, right above the 21 EMA and the 200 EMA, and IWM with the nice comeback today. Gap down. Let's go to the 5-minute. Gapped below yesterday's lows. Slower recovery, took longer, but then the banks caught fire late morning into the afternoon. A little bit of a sell-off into the close. But let's take a look at that KRE now. And you can see closing right on the 21 EMA. We've got an alert set right above today's high. You can see the 8 EMA has flattened out. We're playing ping pong along that, and just some good reactions to earnings in some of these regional banks has been putting to fear the liquidity mini crisis contagion. So there's your KRE. Let's flip to the dollar. Tight range today for the dollar, up slightly. Dollar up. You would expect gold and silver to be down. Note on this chart, it shows UUP continuing to be rejected by the downtrending day EMA, but although it was higher on the day, let's see what gold did. It was down as we'd expect, bounced right off the 21. Basically, we've got our stop for gold now below the low of Monday, which would take out the 21 EMA. So that's a level we're watching closely. That would also correspond most likely with the UUP, the dollar getting above the declining 21 EMA, and that inverse correlation continues to stay strong. Up dollar, down gold stocks also, and silver bucked the trend and closed positive along with the dollar today. So the strongest of those three ETFs definitely was silver. Bitcoin today down 3.44%, making lower lows after its attempted breakout is not sticking. Let's flip to bonds. BND, the broad bond index. Bonds traded in a tight range today. Bonds down, prices up slightly. Or bonds down, yields up slightly. Bonds came off during the day. Let's look at the TLT, the longer one. Gap down and rallied into the close. Looks a lot like the indexes. So closing at the high, we may have put in a bottom on this pullback at TLT. You can see it's pulled back for 1, 2, 3, 4, 5, 6, 7, 8 days, right to this big support area here, this 103.50-ish area, and then there's a gap to be filled down to 103. It's holding there, oversold, certainly on the daily, or approaching oversold, hanging right around this declining 50-day moving average. Looks like it wants to bounce. We've actually bought TMF on the breakout here. That was a miserable failure. We sold a third of it. We're holding the remaining 2/3 now that we're down toward the bottom of the range, looking for a bounce there. Plus, we own, in addition to the long term, we own short term bond ETF, short term treasury bills, more specifically. SHV and SNOXX are the tickers there. So there's the TLT rates. Here's the 10-year up, ran into the declining 50-day moving average, flat 50-day moving average, and near the top of the recent 4-week range. TYX, the 30-year, above the 50-day moving average, also at the top of this recent 4-week range. You can see some resistance from this most recent area in here that it's running into. So those are the key ETFs we take a look at in every video. Let's go to the tail of the tape. You can pause this to read through the whole thing. VIX making a lower low, 1638. Fear and greed unchanged. Here's the UK inflation, knocked the futures down, and then I mentioned that false breakout at 2 p.m. of the Fed Beige Book. It showed inflation, employment, and the economy slowing across the board. That's what the Fed wants. So it's doing the job for them. That was the reason for the initial spike. The market just not quite ready to digest that, with us being 2 weeks from today away from the next FOMC meeting, where there's an 87% chance of a 25 basis point hike. The day count, we went from up 3 out of 4. We're actually in a C4, or consolidating for 4 days now. 17 days above the 8 and 21 EMA. Getting long in the tooth, but continue to hold it. It seems like everybody is looking for a pullback, and that pullback might have been the gap down today, but the bulls said not going to happen. Moving along, here's the action on the day. There's the ranges. KRE up nicely on the day, as I said. XLP finished negative, but near flat. UV and RE, which is utilities, healthcare, and real estate, were the leaders on the day, in addition to financials, represented by KRE there. On the downside, semiconductors lagged, oils lagged, but came back a bit during the day. Bitcoin down, PIC down, and networking stocks down. I'm going to show that when we go through the tail of the tape, why that whole sector got hit. So here's what we own in-house. No changes to the portfolio today. Adjusted beta 1.44. Bottom line, gap down, but a slow trend up, recovers most of the losses into a mixed close. Today, a win for the bulls. Second straight close at 41.55, which is also this key fib from the bear market rally, 50% retracement, and you can see the next levels overhead that are critical to overcome if we're going to go higher. After hours, first of all, let's take a look. Tesla down $5, so let's see what that is, 3.3%. Not the best looking chart. It's really been a laggard relative to the NASDAQ 100. Yes, it's oversold, but not a good reaction today. Their margins appear to be shrinking, and I think they missed sales slightly. Not a big miss, though. So, um, all right, let's get to the focus list, and then we'll go through the 21 over 21 on a weekly basis very quickly. So I showed the KRE chart. The reason why that chart looks so good is because stocks like MCB Regional Bank up 18% on its earnings report, and also WAL, which is one of the big banks that showed big concern by the market, up 24%. So little by little, these earnings reports are putting the contagion fears to bed. Moving on, why we're networking stocks week today. CDW lowered guidance down 13%. That trickled over to some networking leaders, namely a recent leader ANET broke the 21 above average volume. Cisco broke the 50-day on large volume. Juniper, another one. Those three networkers were down on volume on that CDW warning. Let's go to some winners today. Intuitive Surgical up 11%, closed a little better than mid-range. Relative strength at a new high. Nice volume, gapping out of this flat base. Nice stuff here from Intuitive Surgical. Not monster growth numbers, as this is a more mature company at $105 billion, but a nice gap up nonetheless. Another winner, IBKR, initially gapped down, closed, then went positive, closed down less than 1%. Good recovery there by IBKR. IoT, two new leaders that are emerging. IoT continues its strength after two strong days up, had a gap down and closed at the top of the range. This is how leaders act. Good stuff there from IoT, and also DraftKings, name from the past, second straight strong day on that as it comes into the top of this cup base. Relative strength at a new high, good volume patterns over the last 2 days. So those are the key stocks that we're going to look at. Let's go to the 21 over 21 on a weekly chart basis now, since it's weekly chart Wednesday, and we're going to do these in numeric order. That means in the order of how long they've been on the list. We're going to start with GE, just continues this beautiful trend higher on the weekly chart. NVIDIA, which we own, consolidating nicely. You can see 2 inside days after making its high. Big upgrade this week means it's an outside, not quite an outside, but making challenging the highs from actually it succeeded the highs from 3 weeks ago. Just really strong, tight action there as it consolidates its move up out of this base. Actually, 50% from the pivot now in 13 weeks from this 6-week cut base that it broke out of in late January. Looks fantastic. And look at the volume, how it was accumulated along with the relative strength during that move up, and how the volume has dried up recently. Gentle pullback for Palo Alto on this weekly chart. Lantheus continues. This broke out in 1, 2, 3, 4, 5, 6 weeks up now, and along with the relative strength confirming, looks great. AXON near the top of its range. GE Healthcare has just been an absolute beast since it IPO'd. I regret not buying this big time. I talked about it from day one, wanted it to form a base. It formed the base and broke out. Then I wanted to wait for it to get to 21. There's multiple reasons why we end up not buying things, although we look back very often and say, why the heck didn't we buy it? And we're working on that. We're always working on our rules to force us into the leaders, even if it's a small position to get us started, because it's much easier to add to a winner and take that first buy than it is to just ignore it completely. Meta continues to trend higher along this weekly after its flat base breakout. Wingstop at the top of this weekly flat base. PG holding the breakout from the cup and handle. CDNS continues to just work its way higher. Earnings next week. ONON consolidating nicely, making higher highs, but this is a high PE stock, but also a high growth stock, acting quite normal after this week where it was up 46% for the week on 348% average volume. You can see how the volume ticked up on those 3 weeks and it's calming down now. That's what you want to see as it prepares for the next leg higher. ELF, another one that we got stopped out of, didn't re-enter. Uh, Fantastic relative strength on this, just an incredible move. Lulu, tight, 3 weeks tight, trying to break out of it, but the volume's not quite there yet, putting in a handle of overall of this base since its earnings move higher. uh, Rambus RMBS flagging nicely after this big move out of the base the last week in March. Beautiful flag there on Rambus, one of the leaders in the semis. ExxonMobil, 3 weeks tight here after its gap up on the OPEC plus production cut. GDX pulling back after 5 strong weeks. Already talked about this on the daily. Mondelez, tight action after its breakout. FedEx, not going anywhere but flagging after its earnings move. SEA, 3 weeks on lower volume, pulling back after its earnings move up. Race, very tight. Look how tight that is after last week's big volume move above this shelf. And ITB, cup and handle. Home builders just continue to defy the experts, defy the higher interest rates, defy the fact that we're in a supposed recession, and just continues to look fantastic. And that represents a bunch of home builders in there. And with that, I'm going to wrap up Weekly Chart Wednesday. As always, remember, it's not how much you make in the market, it's how much of that you can keep. Our flagship portfolio is called GROTECTION, so we can grow your nest egg when the markets are trending nicely higher and protect it during bear markets. And with that, I will wrap up Weekly Chart Wednesday, April 19th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening. Have a great day.